Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audio cast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
Healthy environments gently pull back from resistance, consolidating as opposed to declining sharply. A guidepost to knowing if an uptrend is ending is when bad news isn't absorbed or contained. Tuesday, October 12th, 2010, this is Conversations, the official MTA podcast series. And today's guest from Raymond James & Associates is Art Huprich. Art Huprich joined Raymond James in January 2001 and became Chief Market Technician of the firm in January 2006. Before then, beginning in July of 97, Mr. Huprich was the Chief Technical Analyst with Ferris, Baker & Watts Incorporated. Prior to joining FBW, he spent almost 14 years as a technical analyst/options strategist with Wheat First Securities. He offers analysis on the stock market, industry groups, and individual stocks, along with commodities, currencies, and interest rates, by researching the supply-demand characteristics of price movement and volume fluctuations. He has been a frequent guest lecturer at Loyola College of Maryland and Schiller International University and has provided commentary for news organizations such as Investors Business Daily, The Technical Analyst, The Washington Post, Investment News, Richmond Times-Dispatch News Radio, and AOL Finance. Originally from Long Island, New York, Mr. Huprich graduated from Lynchburg College, Lynchburg, Virginia, with a Bachelor of Science degree in Economics and Political Science. Art Huprich, welcome to the program.
Thanks, Ed. Good afternoon, everybody. I appreciate your time.
You bet, and thank you for taking the time to join us today, Art. Art, we normally start these podcasts with a little personal background. We know you're from originally from New York, but somehow you ended up in Virginia at school. Tell us how that happened, and once you got out of school, what happened between graduation and your first position as a technical analyst? Give us some deep background here, if you would.
Well, I appreciate the question, Ed, and just the chance to share some information with everyone. I consider myself a northerner by birth and a southerner by choice. And what I mean by that is having grown up in New York and having had enough of the winters in New York, somewhere in my middle to latter teens, I decided that I had had enough of the ice and snow in New York and decided I wanted to go to school in the South. I've been played sports all my life and played 12 months out of the year. And one of the sports that I could play in college, but I had to play at a small school, was lacrosse. Grew up playing and went to a Division III school. I wasn't good enough to play at a Division I school, but I could play lacrosse at a Division III school, which was Lynchburg College. So if you combine the fact that at 18 I was ready to leave, the fact that I wanted to move south and get away from some of the New York winters, and the fact that I could play some sports on a collegiate level, that all brought me to Lynchburg College. And after the first year, Ed, that I studied business, I took one economics class, and the economics professor at the time was trying to expand the department. I guess that's good or bad. And that he came over and approached me about changing degrees and getting an economics degree, which in hindsight was a wonderful opportunity because, jokingly but in all truthfulness, I do use my degree in my profession. And because if you know economics, you're dealing with demand and supply, and as a technical analyst, I clearly use demand and supply in my profession. And finally, as an economics major, I also got my MRS degree. And when I tell people that, they said, "Well, I thought you just said you got a bachelor's in economics. What are you talking about, an MRS degree?" Well, that's where I met my wife. She happened to be the top economics student, and I met her in one of my economic classes, and hence I have moved south, and since she's from Virginia, continue to move south because now I live in Florida. Okay. In terms of how I got started in the business, it's a tremendous opportunity, and I have to tell you that I love what I do. I have a real passion for the stock market, and I count myself blessed, Ed, because many people, many men especially, I like to say they live a life of quiet desperation, meaning they just go to work and it's a humdrum existence. And I am a very fortunate man because I have a passion for the stock market. It's the ultimate form in competition in which I can put my athletic background to work, and I love what I do. So having had an economics degree, for some reason there was a bug in me that I wanted to work with a brokerage firm. And I went to a social gathering one night with the local JCs, and there was somebody there who happened to work in the human resource department of Wheat First Securities. And the guy, as can be the case when you're in your early 20s, had a little bit too much to drink, and he proceeded to tell me and blab on about how there was a great opportunity in the options department at Wheat First Securities. Now, I didn't know what a put or a call was in 1983. And I was just basically out of college, got out of college in 1982, and I happened to call him up the next day and called his bluff. Well, he told me after the fact, he didn't even remember telling me the story, but he got me the interview. Oh. And the gentleman that was running the options department of Wheat First Securities at the time was a gentleman named Tom Dorsey. And I'm sure many of our associates in the MTA are familiar with Tom.
Sure.
He and Watson went out and formed their own company back in 1987 and have done extremely well. But in 1983, I got an interview with Tom Dorsey. Interestingly as well, Tommy wanted somebody with a clean slate who knew nothing about Wall Street, nothing about fundamental analysis. As he said to me, he didn't want somebody tainted with fundamental analysis. He wanted a clean slate, and that was me. Also, what some of our associates may or may not know about Tommy is at the time and many subsequent years, he would teach at the local prison. He would go into the prison in Richmond, Virginia, and he would talk to the convicts, if you will, about options and the stock market and technical analysis. And I happened to read he was written up in the local Richmond paper, and I happened to read the article. So I get this interview with him, and I'm sitting in front of him, and I'm looking at him, and I point at him, and I say, "You're the guy I read about in the paper." Well, Tommy really is a big teddy bear. If you get to really know him personally, he's a big teddy bear, and he just couldn't believe that I had said that to him, and opened up the interview, and we just sort of put all the business, if you will, aside and talked and got to know each other. And he said, "You're the type of person I want because I want a clean slate." So it was a very fortunate, interesting, if you will, set of circumstances that got me to that point in which I interviewed with Tommy. We became friends, and he hired me, and it's been a phenomenal career ever since.
That's great. That's great. Okay, so that's the history. Let's come up to the present day.
Okay.
You're at Raymond James. Give us just a minute on what your typical day looks like.
My typical day starts out early. It actually starts the night before, Ed, because I'm always looking at the foreign markets. Somewhere around 8, 9 o'clock at night, I start looking at the foreign markets and seeing what's happening overseas and what's happening in Asia, then what's happening in Europe, and then what, of course, the U.S. futures are doing. So I come in the morning knowing what has been happening around the world, what some significant news events are, and what's happening in the metals market, in the overseas indices, as well as our currents, as well as our futures. But I write a report every single day. So I get into the office, at 00:00 and have already prepared a list of things that I want to try to write a report about, because again, writing a report on a daily basis and staying in front of our financial advisors and their customers on a continual basis, to me, is important. I think technical analysis gives our advisors an avenue to stay in touch with their clients, and it opens up a lot of communication. So I try to write a daily report in which I can give some thoughts about the previous day's trading, about some of my internal indicators, trends, various asset classes, and then try to in trading ideas both up and down, and also try to come to some type of conclusion. So my day starts early, and it consists pretty much 5 days out of the week of writing a daily report that goes out to our financial advisors and their clients.
All right, real good. We're going to talk more in a few minutes about some of these specifics, but Art Huprich, with the talking heads and financial media, I would say they spilled an awful lot of ink telling us that September was the best September since 1939. What they failed to mention, however, is that after that top in September of 39, the market dropped about 40%. What do you make of the September run-up?
Well, two things. One, we had a decent little internal correction in in August. The market had peaked in April, and the S&P went from its April high to its July low. It dropped approximately 18% on an intraday basis. You had a re-rally, then you had a pullback into August, and our economist loves to say, from his perspective, that everybody goes to one side of the ship, and once you go to one side of the ship and it starts tilting, it's time to run to the other side. So if you take the fact that the S&P between April and July had dropped about 18%, had rallied, then you had another pullback in August, and then you had that as your backdrop, and you came into September, and everybody was talking about September being the worst month of the year, and I wrote to our advisors. I said, I use the sentiment and the calendar as a secondary indicator, which we may be able to get to in a few minutes about some thoughts going forward.
You bet.
But I use it as a secondary, and you need to stay with price and volume. And starting at that July low standpoint, the market was starting to base out, and it was starting to talk. It had already corrected, and everybody was leaning from a sentiment standpoint, Ed, towards the negative side, because here comes September. And I said, forget the calendar, stay with price and volume. And that proved to be a knock on wood, a good call, because everybody had leaned to one side of the ship. And when that happens, it usually pays to start looking and start moving your chips to the other side of the ship. And that's what it was all about.
Yeah. We're going to continue with Art Huprich in a moment, but first a reminder that on next week's program, we'll have from Landor Fust Capital Managers, Dodge Dorland, former MTA president. All right, Art, we're now at a time when a time in our program we call our toolbox, where we talk about the tools that various analysts like to use. You've described yourself as a meat and potatoes kind of guy. I would characterize you as a price and volume guy. What do you make of the fact that volume's been so punk recently?
Well, I say meat and potatoes because I'm a basic technical analyst, Ed. It's like most of us men when we go out to eat. Give me a steak and give me some potatoes and I'm happy. Well, yeah. In my case, give me price and give me volume. Give me some relative strength, not relative strength index, but ratio analysis. How is something trading versus a benchmark? Give me a few moving averages, a few Bollinger Bands, one or two momentum indicators, and I'm happy. And I say that as opposed to many people who follow 50 to 100 different indicators. So I'm meat and potatoes in that perspective. To your question,
go ahead,
about volume. I think right now, and volume's an important aspect, don't get me wrong, it shows conviction level, but we've had two major bear markets in the past 10 years. The NASDAQ dropped 78% from the 2000 high to the 2002-2003 low, and the S&P dropped 58% from the 07 to the 09 period. So from that pure perspective, if you were indexed, if clients, if investors, all they heard was buy and hold, they've been devastated. What I always say is the problem is buy and hold and forget about it. I mean, there are times when you buy and hold and stay with the trend, but I never get caught up in buy and hold and forget about it. So volume, the public has had two major bear markets. They've had all of the shenanigans that analysts and Wall Street and corporations took place in with the Enron and the WorldCom back in 2000 to 2002 period, and now this financial crisis. So they're just overwhelmed. They've lost their interest. So I think volume is important, but I don't measure it the way everybody else measures it. I can't get caught up in, well, we're rallying with no volume. I mean, heck, Ed, we haven't had any volume since March of 09. And if you use that as your reason not to invest, you've missed huge opportunities. And what I think is that when we start getting volume on a big, a volume shows acceptance in this case. That's the way I'm viewing it currently. And if volume starts exploding on the upside to 2 billion shares, for instance, on a consistent basis, that's probably meaning from a sentiment standpoint, everybody's in. I like the fact that the market's rallying with no volume in that. It's showing me people haven't accepted the rally. Now, how do I measure volume on a day-to-day basis with this low-volume environment? We can talk about that if there's time, but hopefully that gave you a general overview of how I view volume within the context of the last 10 years.
Yeah, I like your buy and hold and forget comments. I like to refer to it as park and pray.
Right.
One indicator you did not mention, which from reading your recent reports, I've taken a real interest in, at least your interpretation of the AD numbers, the advanced decline numbers. Uh-huh. Talk to us a little bit about that. What do you look for there, and how do you interpret it?
Well, let me first off say, Ed, that a lot of my colleagues interpret the advanced decline line differently. You have common stock only AD line, you have the traditional AD line, due to decimalization, et cetera. So my own community has a lot of bickering, if you will, or that's not a good word, disagreement amongst us on how you look at things. I keep things basic and simple again. I use the traditional advanced decline line. I believe it or not, as strange as it sounds, Ed, I write the statistics from the Wall Street Journal down. I put them in a binder that I keep underneath my desk. I keep a running cumulative total so I can look at the figure, besides looking at Investor's Business Daily if you wanted to see the AD line. But I use the traditional figures. It hasn't steered me wrong. Our peers can say, well, you need to use common stock onlys. You need to take into account decimalization, et cetera, and what that's done to the advanced decline statistics every day. Yes, I understand that. But in terms of picking out tops, major tops in the stock market, I have a study of the advanced decline line going back to the 30s, and it has picked out all major tops. It picked out the major top in 2007. It picked out the major top. And what I mean is the advanced decline line, the traditional AD on the New York Stock Exchange, and I look at them for the S&P and the mid cap and the small cap index, and I do that. But the traditional New York Stock Exchange advanced decline line, Ed, has, the way I have interpreted, has picked out all major tops. Picked out 07. It started telling you in late 99 to get concerned. It picked out, which helped you avoid the 2000 bear market. It got you out long before the long-term capital management debacle in 98. Same thing in 94. It got you out of the market in 87. So I use the advanced decline line in terms of a topping indicator. I don't use it in terms of identifying a bottom. In that case, I use volume, and I use lows, and I use sentiment. But in terms of a topping indicator, and it usually, based upon my study, the advanced decline usually starts diverging 3, 4, 5 months ahead of a major price peak. And we haven't seen that. The advanced decline line, even with the April top, the advanced decline line, granted we had a nasty decline, but I used some other indicators to capture that. In terms of major bear markets, the advanced decline line, again, even while our community debates about the usefulness of it and traditional versus common stock only, what I have studied has kept me on the right side in terms of picking tops since I've been in the business.
Okay. All right. Yeah. And just to set the record straight, I assume you're talking about the cumulative AD line.
Yes, sir.
Yeah.
Yep.
Okay.
Yep.
All right.
That's why I keep those statistics every day in a black book, which I'm sure people, especially the younger technical analysts who are up with Excel and all modern technology, think I'm a dinosaur. But I've been doing it for coming on 27 years. I might as well keep it.
Old habits. All right, let's move on. Another part of our podcast is communication with the consumers of your research, or how do you go about communicating your research? First of all, who are the consumers of your research? Are they just the advisors at Raymond James, or is it broader than that? And then tell us, how do you decide what's important to include and what to not include in your reports? How do you tailor it to your audience?
That's a good question, Ed. I think you have to. My audience is broken up into two sections. We have retail financial advisors who predominantly work with the general public. and we have institutional salespeople who deal with the institutional investors. I can't give you a ratio of who uses me here at Raymond James in terms of retail versus institutional, but it's a large majority is geared towards the retail side. Why that is would probably take another interview, but that's for another conversation. So predominantly it's the retail financial advisor and their clients. I communicate with them in a daily research report, which goes to our retail advisors, and they either send it to their clients or their clients get it directly from my email distribution list. Also, and again, I alluded to earlier, I write a daily report, I write a weekly report, I write stuff that I see significantly happening during the day, during the week, anything that I want to comment on. I've got the freedom to say both positive and negative. And the beautiful thing here at Raymond James, and it should be the case for all of my colleagues, is if I see something that's in total disagreement with what our fundamental analysts are thinking, I've got the freedom to say sell, even if our fundamental analysts are saying buy. So my research is completely unbiased. It's what you see is what I see is what you get. It comes out daily, weekly, intraday, interweek on any topic that I feel like discussing or any movements I start seeing. And I also go out on the road and meet with branch offices as well as client seminars, and also national seminars with our advisors, where we may bring in 100 or 200 or 1,000 advisors for an educational conference for them. They'll bring me in to speak, and again, I will also speak to client seminars as well, lunch seminars, breakfast seminars, dinner seminars, whatever the case may be.
All right. Art, we are running out of time very quickly here. I've still got questions I wanted to ask. I'll tell you what, let's see how quickly you can answer some of these questions.
Okay. Sorry.
Yeah, because we literally are out of time. We're over the timeline already. You're a CMT. Tell us how the MTA has played a role in your career in 15 seconds.
The MTA has played a huge role in helping me because the MTA, when the Series 86 and Series 87 exams came out that all analysts had to take in order to remain, quote, an analyst, the MTA, I owe them a great deal of gratitude because they went to the governing bodies, because these tests, Ed, were geared towards fundamental analysts. And really the one test one was a legal compliance test and one was another analysis test. And that was like the CFA2 test. That had nothing to do with technical analysis. And our body, thank goodness, went to these governing bodies, our body, the MTA, went to the governing bodies and said, you people don't understand how we operate. And as a result, through their efforts, the governing bodies said technical analysis is a legitimate form of analysis. And if you have passed the CMT, the Chartered Market Technician exam, you do not have to take one of these tests. And that was unbelievable in how it helped me in what I do.
All right. Last question. Tell us, share with us, who have been some of your greater influences, people that have inspired you or educated you, favorite books that you think we should all be aware of and be reading, that sort of thing.
Okay. Well, that's actually an easy question. First and foremost is going to be Tom Dorsey. He took a chance on me back in 1983, brought me into the business, and he taught me point and figure chart analysis and option strategy. So Tom Dorsey had a huge role because my slate was green, and he helped me. And then really, it goes from there. I worked with a gentleman named Don Hayes at Wheat for Securities, who, more than anything, Don let me develop and be the type of technical analyst I wanted to be, which is how I became a meat and potatoes, keep things simple and basic technical analyst. And then my colleague and friend here, who has retired at Raymond James, was Ralph Block. And Ralph didn't teach me so much about technical analysis. He just taught me about, stepping back and looking at things a little bit differently. And also, he was a master of talking to people. And Ralph helped me develop my skills in terms of getting in front of an audience and communicating my thoughts to them. Some books. I love How to Make Money in Stocks by William O'Neill. I love John Murphy's book. The basic, I think, that I tell everybody to read is Technical Analysis of the Financial Markets. I've got a couple other books that I think are important. One book that you can't get anymore, or it's out of print, is by Stan Weinstein, Secrets for Profiting in Bull and Bear Markets. Those are some books, and I've just got a number of them, but those would be the ones that would stand out from my perspective.
Okay. Art, we are so far over the time, our time limit. I think Shane's going to have a field day with the scissors on this one. But I want to tell you, it's been great having you with us today. We do appreciate you making the time and sharing, your background with us and your experiences in the industry. And we're just going to have to wrap it up right there. Today's guest has been Art Huprich, and that wraps up this week's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer, Shane Squark in New York City. Say goodbye, Shane.
And we'll see you next week, everybody.
Let's keep our stops tight. Good day.